Welcome to our second discussion related to posting entries. In this discussion, we're going to focus on the second month of family health care. If you remember, last discussion, we concluded the first month of activity for family health care, and we ended up with balances as of May 31st of cash at $5,900, accounts receivable at $1,200, land of $12,000. In our liability section, we had $9,000 in notes payable, and in our stockholder equity, we have $6,000 in common stock and $4,100 in retained earnings. Now keep in mind that these are the ending balances, which mean that they will then follow through to the next month and become the beginning balances. So what we've done is we've transferred all of the accounts, cash, accounts receivable, land, notes payable, common stock, and retained earnings to the month of June. The focus of June is that we're going to be going through some very specific accrual-based accounting type transactions. Not in this video, but in the next video, we're actually going to be doing adjusting entries so that we can actually complete the balance sheet, income statement, and the statement of retained earnings and stockholder equity. So in this video, let's go through some very specific transactions and see how these actually work out in terms of our listing. So the first transaction is on June 2nd. So on June 2nd, Family Healthcare receives a payment of $1,800 in cash in advance for the use of its land for 5 months. Essentially what's taking place is we have what's called unearned revenue. Unearned revenue is a liability in the sense that we actually owe something. So in this case, what we owe is rent, the availability of that space for the next 5 months. So let's look at this transaction. So it does say that we received $1,800 in cash. So we're going to have $1,800 in cash over here. And then the liability side is we have unearned revenue. So the unearned revenue is a liability, and we are going to put $1,800 in unearned revenue. Making sure that we understand that that unearned revenue is a liability because we owe something. We owe a resource. The resource is the availability of its land for the next 5 months. When we go through the adjusting entries, we are going to account for the fact that at the end of the month, we actually have earned the first of the 5 months payment as revenue. But at this point, all we have is unearned revenue. The next transaction is that Family Healthcare buys a 2-year business insurance policy and pays $1,800 in cash. So since we paid cash, it's going to be a negative entry in cash. And you notice that the next piece of this is that what did we do? We actually bought an insurance policy. So when you buy an insurance policy, what we have is we are prepaying the insurance. So we prepaid the insurance. We have an asset of the insurance. It only becomes an expense over time. So at the end of the month, we are going to account for a month's worth of insurance expense. But at this point, as insurance is one of those resources that expires over time, the very beginning of the transaction, we actually do not have an expense. We have a resource or an asset. Very similar to what we see right here. So what we see is a Family Healthcare buys a 6-month medical malpractice insurance policy and pays a premium of $3,000. So again, what we're going to do is we're going to have a reduction in cash because we've actually paid for the insurance. and the medical malpractice insurance is insurance. So we are going to actually record this as insurance, and we see the transaction right here. Let's look at the June 13th transaction. So June 13th transaction is as follows. Dr. Landry, you notice it's not family healthcare, but actually Dr. Landry invests an additional $5,000 in the business and receives capital stock. So the company, the business of family healthcare, receives $5,000 in cash from Dr. Landry. And what do they give in return? Well, they give in return common stock. So this is $5,000 in terms of common stock. Let's look at the next transaction. The next transaction is that family healthcare purchases $300 of supplies on account. Now, in our last discussion, we talked about when a customer buys something on account, we have an accounts receivable. Now what we're doing is we are doing the purchasing, so we actually owe the money. So what we have on June 15th is we have $300 of supplies. So the supply account on June 15th is going to go up by $300, but we didn't pay cash for it. What we did is we now have an accounts payable. Let's look at June 17th. June 17th is that family healthcare purchases office equipment at a cost of $7,200, making a cash payment of $800 and placing the remainder on account. So what do we have here? So we have to do a little bit of math here. So on June 17th, what we have is we have office equipment in the sum of $7,200. Now, some of this we paid in cash. So we paid in cash $800. So this is going to be a negative amount of $800. And the rest of it is going to be accounts payable. So accounts payable is our equipment costs of $7,200 minus the cash that we paid. So what we have is in accounts payable, we have an accounts payable of $6,400. So again, you notice this transaction right here is we bought equipment for $7,200. We paid an $800 deposit, and the remainder is on account. When we're doing the buying, on account implies that we have an accounts payable. Let's look at the next transaction. The next transaction is as follows. Is family healthcare performs services to patients on account for the amount of $6,100. So now on June 19th, what do we have is since the customer is putting it on account, we now have an accounts receivable. So the accounts receivable is $6,100, and this is revenue. So you notice that we perform services. So we perform services. That is what we do, is we perform medical services. That's the core of the business. Therefore, we have revenue, and revenue is going to be reported as an increase in retained earnings. So we have $6,100 over here. Let's look at the next transaction on June 20th. So June 20th is what do we have? Family healthcare performs services to patients who pay in cash for the amount of $5,000. So on June 20th, we actually received cash. So we received cash of $5,000. This still is revenue. So the revenue is going to be $5,000 as an increase in retained earnings. Now let's look at the June 22nd transaction. Family healthcare receives $4,200 in cash payment from patients' insurance covering prior services performed. So on June 22nd, in this transaction that we see right here, we receive $4,200. So we have $4,200 in cash because we received this. But where is that cash? Is that revenue? No, we've already reported the revenue. What we have is we have an accounts receivable. So that $4,200 is going to be a reduction in accounts receivable. Let's look at June 25th. So June 25th is what we have is Family Healthcare pays $100 for the supplies previously purchased on account. Did we buy more supplies? No, we just paid the bill. The credit card bill came in, we paid part of it. We didn't pay it all, but essentially what's taking place on June 25th is we are paying $100, which means this is a reduction in cash. And then we are also reducing our accounts receivable by $100. Why are we doing this? Well, we owed, and this is really related to this transaction right here, we bought supplies for $300. We're now paying $100 of those supplies. We're not buying new supplies, we're simply just paying the bill that we owe. In our next transaction, you notice on June 27th, Family Healthcare pays a dividend of $1,200. This dividend is paid to our sole owner, who's Dr. Landry. So on June 27th, we have a cash payment of $1,200, and dividends represent a decrease in retained earnings. It's not an expense, but it is considered a decrease in retained earnings. Our last transaction relates to the expenses that were incurred during the month. So during the month, we had expenses of $3,800, and these could be various expenses. We're just simplifying this as a single transaction. These were all paid in cash. So cash is going out the door of $3,800, and the expense essentially relates to a reduction in retained earnings. What we're now able to do is to determine our balances prior to our adjusting entries. In our next video, we'll talk specifically about the adjusting entries, but before we do this, this essentially is our trial balance. Once we do the adjusting entries, we have an adjusted trial balance, but at this point, we're essentially looking for the balances. So what we want to do is we want to sum each of these rows as part of our balance before our adjustments. So we're going to sum all of our cash. We should be able to scroll this over. And these are our balances. To make sure that these equal what we have here for our cash is $38,600. For our liabilities and stockholder equity, we also have $38,600. So the transactions are in balance. In our next video, we will actually go through the adjusting entries. Thank you very much for your time, and I'm looking forward to our next discussion.